Welcome back, investors, to Ticker Time News. I'm Adam, and WEBR, ticker symbol WEBR, is getting hit with a sell-off after the company missed earnings and revenue expectations for Q1. The grill maker ran into soaring supply chain costs that sliced gross margins nearly in half year over year from 43.6% to 22.6%. Then, to add to the pain, grilling was not in season in every country in which WEBR operates, except for Australia and New Zealand. Finally, settlement today is not being helped by WEBR's prediction that conditions will not normalize during fiscal year 22. Okay, before we get too far into WEBR's earnings failures, smash that like button, share this video, and click the first link in the description to get our top 10 stocks list and so much more. And if it's your first time watching, click that subscribe button. Thank you, my friends, for doing that. Digging deeper, WEBR posted a non-GAAP net loss of 19 cents per share, while revenues dropped 8.4% year over year to $283.1 million. Most of the decline was due to the supply chain shortages. The Americas region saw sales decline year over year by 13%, and the EMEA region by 4%, while Asia Pacific sales came in flat. However, when looking at revenue on a 2-year stack, WEBR looks much better. America's net sales are up 67%, EMEA up 126%, and Asia Pacific sales are up 57%. Still, this zoomed out view paints two conflicting pictures. On one hand, the solid 2-year sales growth shows the strength of the WEBR brand, which flew off the shelves during the height of the pandemic. It also indicates a potential issue for WEBR going forward. WEBR reached its peak popularity primarily because of the COVID-related restrictions that fueled demand for at-home and outdoor cooking. WEBR already reaching its peak in popularity is definitely a concern. However, I think WEBR's current issues are largely macro in nature rather than a problem of the company's fundamentals. WEBR is still very much in a growth phase, domestically and internationally. For example, one of its core growth strategies is to accelerate its direct-to-consumer and e-commerce sales, which could help expand margins. Another strategy involves upping its footprint within the global retail space, expanding its current presence at Best Buy, Costco, and Amazon. Finally, a potential catalyst stems from WEBR's move to enhance its presence in China, which it's already building upon through its plans to open its first WEBR store in Shanghai for the 2022 season. Overall, WEBR got burned in Q1 as supply chain costs leaped higher. Shipping container costs jumped from around $4,000 in Q1 21 to roughly $15,000 this quarter. And WEBR does not expect the situation to improve much throughout fiscal year 22. It noted that inbound freight is likely to represent 16% of its fiscal year 22 cost of goods sold, a 200% jump from 2 years ago. The good news is that WEBR still commands pricing power given its premium brand. The company is implementing price hikes to help offset some of the inflationary pressure, which should help improve margins quarter over quarter over the next few quarters. For example, WEBR expects over 12 points added to gross margin year over year in Q2. Bottom line, as WEBR is trading about 30% off its IPO price of $14 a share and a reasonable 17 times fiscal year 22 earnings, it is a solid turnaround play, especially if macroeconomic conditions begin to improve. Well, that's what I think about WEBR right now. But I want to hear from you. What do you think about WEBR missing its earnings? And remember, your comments make these videos so much better. Smash that like button, share this video, and click the first link in the description to get our top 10 stocks list and so much more. We've done the research so you don't have to. And if it's your first time watching, click subscribe. Thank you so very much for watching, and I will see you in the next video.